investing $10,000 into ABR, Arbor Realty, with its near 12.5% dividend yield. Absolutely insane. Welcome back to this series, guys, where I'm talking about investing $10K into all these different high-yielding dividend stocks and ETFs and going over how much dividend income you would make if you held $10,000 worth of shares. So if you guys came from my other videos, welcome back. I'm glad you are here. Let's just jump into it. If you guys don't know, Arbor Realty is a REIT, a real estate investment trust, and it's a mortgage REIT. REIT that I don't typically recommend because REITs like ARR, ORCC, NLY, all of these REITs that have done terribly with their price appreciation, Arbor is very, very different, but still there are some risks and we're going to talk about it. We're going to go over the price appreciation. We're going to look at the website, what we're looking at right now, their dividend history, some things from their website about how they've been doing in the market, as well as a drip calculator return to see how you would do if you invested 10K 20, 30 years ago. Would you be positive? Would you be negative? Would you be rich? And then we're going to finish it off with that dividend calculation to see how much money you'd make in dividends after 1 year, 10 years, 20 years, and 30 years of holding the stock. So I hope you guys enjoy. Let's jump right into it. Quick data from Google: market cap 2.6 billion, not too big. I like that you still have some growth, but it is pretty large, so you're not expecting a ton of growth over the 1 year. Anyone else's Google been messing up lately? Mine keeps saying chart unavailable. They're still up 7.3%. And they were at 1762 at one point. I know personally I'm up about 14% on all my shares of ABR, but it has been a bit of a downturn in the market, and we all know that reason. Or if you don't, it's because of the cost to borrow money. Because our interest rates are through the roof right now, it is hard for funds that use a lot of leveraged debt to purchase properties, to expand, to survive. So when it comes to these REITs, they are really, really beaten down. To be honest, this is not financial advice. I'll say that at the beginning, not financial advice, but I am buying up a lot more REITs than I normally do because I think that they are going to be a good bounce back opportunity in the market. So the max chart shows they traded all the way back in 2004. We can see this crazy downtrend after the market crash, the real estate market in 2008, 2009, where it fell 97%. But had you purchased it then at 90 cents, you'd be up 1,400%, which is absolutely crazy. So we know the dividend yield is 12.45%. They've been trading all over the place in the last year, but they are on the lower end as we anticipated. So now let's look at their dividend history. A beautiful dividend history for ABR. 10 years of consecutive dividend growth as well as consecutive payments, which I think is great. They're a little bit below the sector median, meaning that a lot of REITs have been paying out for more than 10 consecutive years, but we'll talk about that. So on the 5 years, they are up, or on the 3 year, I should say, about 2021, they were paying 33 cents a share. They're now up to 43 cents a share. 5 year, 10 year, they did pay one special dividend in 2018, but they're not very consistent with their special dividends. They don't pay monthly. They are a quarterly payer. But if we go to their max chart, we'll see this was that cut in 2008. They stopped the dividend altogether for a number of years before starting it up at 8 cents. And now we're all the way back to 43 cents. It still hasn't reached the high that it was before this crash, but who knows if it will, because the market was just insane back then. So I wouldn't really expect it. So let's go down and look at this dividend history. We can span it all the way back to a long time. So we can see 2008, this was their dividend. They were paying 62, and then they cut it completely, and then all the way to 2012. And since then, they've grown it at about 7.5 cents a share, all the way up to 43. Now, I like Seeking Alpha because they'll give you this dividend scorecard. Let's double check what the yield is. This says it's about 11.72, still a really good amount. Payout ratio is really high. I need to look into this more because payout ratio is really, really important when it comes to REITs. 5 year growth rate is a 10.6%, which is really, really important. I'm very, very interested in buying more shares of ABR, but I'm just not quite sure yet because it's a little bit scary with how REITs have been performing, although I do own probably too much of this for my portfolio so far. But like I said, I'm a big fan. It has a huge yield. And what more do you need than that? I'm just kidding. You need price appreciation, but the price appreciation's been doing well as well. So what we're going to do now, we're going to look at some stuff from their website. Let's just check that out. So this is the fact sheet for the company from their website, and I checked into it. The payout ratio is about 81% for ABR, which is pretty low. Seeking alphas gets messed up sometimes depending on the data, but I did double check, and it is about 81%, which I'm okay with. Above 70, I get a little bit hesitant, but let's talk about some of their highlights. So it's an internally managed REIT. I like this. They save money. They're not having to have an outside company come in and manage everything. So this is a bonus. Sometimes the externally managed ones can be more profitable, but it really depends on the internal team and what they're capable of. So they have diversification, as we've seen. A lot of information on here. I'm not going to go through every little thing. One thing I wanted to know is their agency business. Their agency loan originations of $846.3 million, a servicing portfolio of $31.38 billion, up 9% from Q1 2023. We always like to see some growth. So you can see down here, multifamily. So what this company does is, like I said, it's a mortgage REIT, but they specialize in multifamily over single family. And there's a lot of reasons someone might do this. When it comes to multifamily, you are typically looking at businesses. It's less common for someone to just own a multifamily and live in it and rent out the sides, although people do that, and I do think it's a good option. They focus in on businesses, which I like. So 87% in that multifamily. Single family is 12% and 1% land. I wouldn't hate more land, but you're not going to get a lot of returns on land that you would for a REIT. So they're probably just holding the land to have some land, or maybe it's undeveloped land and they're waiting for it to be developed. Who knows? But only 1%. So they do have a lot of these multifamily properties. Now, where they're holding them: Texas, Florida, Georgia, North Carolina, New York, California, South Carolina, Indiana, Maryland, and other. The main being Texas at 23%, and then Florida at 17%. The largest is other at 27%, meaning they own a ton of properties in different states. Because if other is the largest category and it's not one specific one, then they have a huge mix up in there, which I love. But I do also really appreciate Texas and Florida, two of the most booming real estate markets in the U.S., being at the top of the list. And then you can see their agency servicing portfolio: Fannie Mae, Freddie Mac, FHA, private label, Bridge, SFR. So Fannie Mae being their top, FNMA. A little bit small font, but definitely not too bad. Now let's jump into this. I wanted to share this one chart from their growth because it's actually insane. So ABR put this out. I can't even remember the date. It's their most recent. It's their Q1 of 2024 earnings, 5-year key performance metrics, May 2024. So peer group comparison, total share. So peer group, I'm assuming the peer group is just different REITs in a similar sector. So the peer average, they outperformed in their 5-year shareholder return, which, like I said, I'm up 14%. I've owned this for a while, and I reinvest my dividends. So that's not including the dividend reinvestment, but it has been performing well, especially after that pandemic plunge that we took. And then let's see, peer group comparison, book value per share, and dividend. So ABR is the green for their book value per share, continues to trend up, and their dividend continues to trend up, is the blue, up 59% in the last 5 years, which is insane. Whereas the peer group, other REITs in the same area, sector, are down. Now, this could be a little bit like if they internally created this, they could have chosen groups that did not perform well. But to be honest, like I said about mortgage REITs, they are typically terrible investments, in my opinion. Not financial advice, but typically they're terrible investments. So to find a REIT that's down 18% and 26% on their dividend is not surprising to me at all. It would be relatively easy to do. The three I named are probably around there already. So I like this. This kind of flexes their growth and their ability to just make good money and continue to get good returns for shareholders in the end. Now let's take a look at the DRIP calculator to see if this thing would have performed well over the last 20 or 30 so years. So first, we're going to test the DRIP calculator against the S&P 500 with 10K invested. We're on dividendchannel.com. Great. I love their DRIP calculator. And wow. Let's not jump to conclusions, right? So for ABR, this DRIP calculator with dividends reinvested, which is key, a $10,000 investment in 1995 would net you a total of almost $387,000, a total return of 3,771%. SPY in that same time frame with dividends reinvested also nets you an insane return of 1,433%, bringing your total to $153,300. Insane returns for both. Like, I'm not arguing one over the other. I like SPY. I hold SPY as well. But ABR's growth has been insane. And part of this has to do with the housing market. The housing market, of course, took that dip that we saw. But housing always goes up. The stock market always goes up as well. The housing market has had explosive growth since the 2008-2009 crash, and we can see that in the reflection of the price. Now, with dividends not reinvested, ABR still comes out on top with a return of 1,800% versus SPY's 1,000%. So with dividends reinvested, ABR makes you more than double the amount of money that you would have made against SPY in the same time frame. So now I want to do something fun. Let's check this against some of those other funds that we talked about. Like, what were some of the ones I called out? Let's do NLY. This is Annaly Capital, which is actually a bit better performing than the other mortgage REITs I've seen. So 10K since 1997. Annaly would still be up 800%. ABR 1,800%. ABR wins 4 times the amount. It's just better. Let's check ORCC, one that's really popular. It has like a 23% dividend yield. And now you see why. So 10K invested would net you $4,000 positive since 1999. If you're making $4,000 in what, 25 years? Financial advisor. You need a financial advisor. Just absolutely insane. ABR comes out on top almost all the time. So it's not ARCC. There's another one, but I think you guys get the deal that I'm talking about with ABR versus other mortgage REITs, because it just comes out on top. So now we're going to do this calculation and see how much money in dividends you would make with their current yield of 12.45%. I'm on dividend.com. We're using their dividend reinvestment calculator. And after 1 year, this one's easier math. You would have a total of $11,245. Your total returns in dividends would be $1,245. Phenomenal. No complaints there, right? Let's go to 5 years. 5 years, it really starts to grow. You're now making $2,000 a year in the dividends alone. Your total return is $8,000. So you have made 80% of your initial investment back, and your total amount that you own, the total value, is $18,000. It only gets better from here, guys. Now, when I've done this, I did this for so many different ETFs. QQQI, SPYI. I just did one on CONY, TSLY. Check those out if you're interested in these videos. I really like making these, and it's really interesting to see how these funds perform against each other, as well as in the market as a whole. 10 years. 10 years. You now make $3,580 a year off of dividends from a $10,000 investment after 10 years. Your total return is $22,000, and your account value is $32,000. Of course, $10,000 more than your total returns because that's your initial investment. So we're going to jump straight to 20 from here. Hold on, because this is where it really starts to take effect. So now you are making $11,571 a year off of the dividends. At year 19, 19 years is a long time. But at 19, you are now making your initial amount of money invested every single year in just the dividends. Now, I'll note, as we talk about how great this is and how great this looks, if the price drops, that's not reflected in this. This is if the price traded sideways and the return remained the same. That never happens. I can confidently say a stock has never traded sideways and the return rate has stayed consistent forever. Hasn't happened. So note that. This is not just, oh, yay, free money if I can put 10K into ABR. No, do your research and let me know what you think in the comments. Like I said, I'm biased because I own ABR. But now we're making $11,000 every year off of the dividends. We have $94.5 thousand in returns total after 20 years, which is great because $10,000 isn't an obscene amount of money. Obscene. You can put that into the market. Maybe most people would struggle with that. Everyone would struggle to a certain extent, but it's not the point I'm making is it's not a number that's out of reach. We're not talking about $350,000 that would take you your entire life to save up. We're talking about $10,000, saving up a couple dollars every day for a couple years, and you'd be there. The final number, 30 years at a 12.45%. With 10K invested in ABR, We now make $37,410 every year. You're now making what? A minimum wage salary every year off of a 10K investment you made 30 years ago. This is why old people are rich, guys. This is why. Time in the market beats timing the market. Total returns, $327,000 off of a $10,000 investment. Absolutely insane return. That'd be what? A 3,000% return? Wild. Total money is 10K more than that at $337,000, almost $338,000. So in reality, ABR, from what I've seen, they're phenomenal. Again, I'm biased. I love this company. It's made me money. It's made me dividends. I couldn't be happier with what it's done. But with everything, there is risk. There's a lot going on, and this company has been hit by a lot of attacks by short sellers, amongst other things. So if you're not interested in buying it now, or say you're thinking about it, but it's a little bit too high, it's getting attacked all the time. It drops 5-10%. That's when I typically do my buying, and that's why I'm up. But that is not financial advice. I want to know what you guys think about this, and if you like these videos, let me know by liking the video down below. Hit the subscribe button, and I hope I'll see you in another video. Thank you guys so much for watching. Bye-bye.